We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Greg Weldon, publisher of Weldon Live, 39-year financial market veteran and commodity trading advisor. How are you today, Greg?
I'm great. How are you? Coming from sunny Florida. It's a wonderful life.
Oh, that sounds awesome. I'm in sunny Alberta, and it's not quite as warm, but I appreciate getting to chat with you for the first time on the podcast here.
My pleasure, man. So,
Greg, are we starting to see a credit contraction partly as a result of the money printing that the Fed did in 2020 to 2021 and tightening of lending standards now as banks are being more careful?
Absolutely. I mean, it really has only just started. You have to separate a tightening in monetary conditions, which is what the Fed has executed very aggressively, and then a credit crunch really is what it amounts to. And the big fear is let's not cause a credit crunch because this economy runs on the fuel of credit. We know this. I mean, and you're in a position now where consumers have basically, really depleted their savings. You had this big savings pool that they printed all this money and gave it away. And to some large degree, that pool has been spent. It's causing consumers whose paycheck is worth, buys them less stuff by the time they get it to the bank to cash it, for crying out loud, has had to borrow money at an unprecedented rate. I mean, the Fed's consumer credit numbers have been off the charts. I mean, it really has been mind-blowing to see how much credit has been created. It's almost $1 trillion just in consumer credit, which is just really, amounts that we have never seen before and almost unfathomable, if not for the fact that the Fed has backstopped all this with printing of trillions of dollars on multiple occasions. Mm-hmm. The fear is, of course, now that, banks will scale back, that there is now a little more scrutiny here. We understand you can't print $17 trillion and backstop every deposit. It's just not possible. It's not quite as bad as it was in 2008. Since then, banks have raised cash. They have a cash holding, several $1 trillion. They have, $5 trillion in securities. That was not the case in 2008 when pretty much every dollar deposit was immediately credit. But that's kind of saying, okay, you're going to walk into a 600-degree room instead of a 900-degree room. All right, you're still going to melt instantaneously. So it's kind of a moot point, but it's worth noting. And even that, if you have a situation where banks have to sell securities like they just did, record amounts of security sales by commercial banks on the back of record deposit outflow like we've never seen before in this entire 50-year credit bubble. Have not seen that. So yes, the big fear I would think for the Fed, looking at another tightening possibly, which is like why, is afraid that, hey, if we cause central bankers to pull back from lending, that will be a real problem. And you've seen it. You really, really have already. I mean, there's wobbles in the weekly commercial bank data that suggests maybe you're going to get a contraction in credit, and especially if it's credit available. And let's not forget credit demand. I mean, how much more credit can consumers borrow? Is this a thing where they think the Fed's going to backstop every dollar they borrow so they don't care? I mean, or is there a limit? And I think we're going to test those boundaries in the near future.
Yeah, it seems like it's MMT for the bankers and MMT for the consumers as well, right?
Yeah. Well, it kind of is, and it's funny because I wrote a book on this in 2006. And there was before MMT was the craze that it just kind of was making rounds. The first time I heard it, I'm like, what are you talking about? It's kind of crazy. And, I was actually on some of the people that had advised the ECB on negative interest rates, even to the degree that this is where the idea came from. But I wrote about it in 2006 because if you're on this current path, the last thing you want is a credit crunch. You can't afford a consumer cocoon, which is kind of what we're already seeing happening, because that drives the economy. And with this much debt, you need the growth. What's the next growth engine going to be? This is where kind of, I think, Jerome Powell, who seems like a very likable guy, I'd love to have a conversation with him. He seems like a very gentle soul. But on the other hand, Paul Volcker is his hero. He said in 2018, we are going to let inflation get above average. We don't care how high it goes. There were no tolerance bands or anything. 300 pages of white papers, 11 different white papers they wrote in 2018 on the new policy paradigm. They did everything they said they were going to do. What they didn't really think about in terms of Paul Volcker was Reagan coming in, and the aftermath of Paul Volcker could spend as much money as he wanted. There was not the same kind of debt load you have now. That was a big mistake. But even to kind of get back to what you're talking about, yeah, you have all these fears around, how far is the Fed push? Are they going to break something? You kind of already have something broken. It's hurt confidence. So I think they need to be very careful going forward here, because inflation base effect only just kicks in now. The April readings, which come in May, okay, we don't get this data for a month. Gasoline last year was at $3.50. In May last year, it was $4.35. You're looking at huge, unless we get a big rally in gas, which could happen, absolutely could happen. But sans that happening, you're going to have a huge downward effect still on energy that's going to take inflation probably to a 3 handle, and then the Fed's tight at 5 into a recession. So a lot of questions to be answered here, and I think the Fed has this in their head. They want to get to 5.5 because that way they're above the level of inflation enough to be restrictive without taking into account inflation's coming down anyway.
Mm-hmm. I'd like to
although that's a short-term phenomenon too. So they got to weigh that also and weigh the lag effect of how much tightening they've already done. Mm-hmm. So, you're seeing signs of recession, and I think that's only just starting as well, especially in the consumer.
Mm-hmm. I'd like to step back for a second if we could and talk about what's happening with bank deposits. We kind of touched on that, but how dramatic is that chart right now, and how out of character is that condition?
It's way out of character, and it's very dramatic. The question is, is the drama over? And I would say it's over for now, maybe. I mean, the problem is that confidence has been a little shaken, and, they had to kind of scramble. And the degree to which it exposed the fact that they can't print $17 trillion if you had a legitimate run on the banks. Is that going to happen? I'd say the chances are small, but they're not zero. Mm-hmm. That's what we do here. We assess risk and reward. In this case, the risk of that happening, it's pretty much been zero for all practical purposes. Never zero, of course, if you look at the numbers. But now people realize it's not zero. So that instills a degree of, uncertainty, all right, which you talk about the uncertainty index and some things. The uncertainty is high. And what was the biggest thing to me was one data point that I didn't hear anyone else talk about in this context, which was the Michigan Consumer Survey, which showed inflation expectations, which have been coming down. Consumers have been bang on inflation. The New York Fed household survey is a treasure trove of information, and they've been really good at calling inflation, frankly. Mm-hmm. And it came all the way down to 3.6, and in the most recent month, it jumped to 4.6. And that's a huge 1 month jump. I mean, consumers don't change their opinions that much on something like inflation in 1 month. And it's like, why? Why? Because you just had, outside of 3 pandemic weeks, the largest single weekly printing of money by the Treasury and the Fed in history. The people see that. And what this is, and this gets to a whole nother risk parameter, is that you are probably seeing a Fed that is going to have to back off maybe before they want to. And in some essence, acquiescing to a 40-year turn in the inflation trend from lower lows to lower highs. Mm-hmm. And now the trend is higher. And they're acquiescing to that to protect the system. What are they going to do when they have to protect the consumer to keep the growth growing so we don't have a credit contraction that's real and organic?
Mm-hmm. So as you're saying they're acquiescing to this new, let's say, inflation paradigm, does that mean that they're going to have to accept and target higher inflation going forward?
Well, it's an interesting question if they're going to target it, because they've targeted 2% for years and couldn't even get it, right? Mm-hmm. So I remember using the theme waiting for Godot for many years. When you're talking about the Fed trying to get to 2%, they wanted to get above 2%. They wanted to stick there for a while. Same thing Jerome Powell said in a much more aggressive way in 2018. Mm-hmm. But they couldn't achieve it. It was like almost unachievable. You keep getting these waves of deflation for various reasons, most of them secular. And then they printed all this money in 2008-9. You still didn't get a big inflation like a lot of people had expected, right? And so it was waiting for Godot, which, if you know the play by Samuel Beckett, these two guys sitting around waiting for some dude named Godot to show up. He never shows up, and they just sit around for an hour talking, and that's the whole play, right? Mm-hmm. On 2020 into 2021, I adjusted that and called it the waiting for Godot, the alternative ending. That Godot was going to show up. And when he did, you were going to wish he hadn't shown up, Godot being inflation. So the question kind of now is, has Godot left the house or the building, the old Elvis phrase, right? And I think if you look at some of the numbers out of Spain or India, we talked about India off air. I mean, there's signs that Godot has left the building because of the base effect. The question is food. And food is a big issue here in inflation. So I guess the question becomes, they're tightening into be restrictive. Inflation comes down. All of a sudden, they're restrictive without tightening again. So how all that works out without causing a credit contraction for real, I think is the biggest question right now that we're facing. And that's not even one they're yet addressing, because they think they're going to still get to a place of more restrictiveness and then stay there for a while. The market's not pricing that. I know, hey, the forward Fed funds is saying, no, you're going to be at 3.5 by the end of next year. That's a dichotomy. And that's something I don't think the Fed is comfortable with. So I think ultimately they're going to be forced to acquiesce to higher inflation. Yes, to make a long answer short, yes.
So, you mentioned earlier that the consumer is starting to, in some ways build a cocoon. Is that because they're just hunkering down because of inflation, because of their record levels of debt, and now this more, let's say, restrictive monetary policy going into what, most people see as a recession?
Absolutely. And I think, there's one way to just very quickly look at it. Of course, it's very complex, and that's why we love to get up every morning and dig into the data as deep as we do. Mm-hmm. If you look at credit card, the charges on credit cards that are actually charged interest, okay, it's record high. I mean, you got to go back to the 80s. You got to go back to Paul Volcker to see these levels of interest rates, 21, 22%, right? Record credit card borrowing. Why? Because people can't pay the bills otherwise. When you're talking about higher insurance, higher public transportation, higher parking. If you're a commuter and they're forcing you back to work, you're kind of getting screwed, because the prices now versus 3 years ago are through the roof for every step of the way. Mm-hmm. So from that context, where we see the consumers have borrowed the most money ever at the highest interest rate ever. So to me, that's a problem down the road here. And so to me, it's a consumer where if you look at, say, the bottom 2/3 of the income scale, are really choking already, where it's been difficult to make ends meet. And thank God for some downside inflation. But let's also point out that inflation on the downside is energy. Would you spend more money filling up the tank of your car every month or on your rent? You spend it on your rent. Rent is now at a new high. Rent of shelter is 8.8%. Mm-hmm. That's huge. So I think there's still a lot of pain to come, especially for the lower half, even if not the lower 2/3 of the income scale, while the higher, income levels still are not feeling quite the same pain. I think there's maybe just a touch of rollback. Maybe it's not as frothy when you go out and as grandeur as when you go out. I can kind of see that and sense it some here, even in South Florida, where, you're looking at most people out here, are much higher income people. So, I sense it, I see it, I feel it's in the data. So I think that will intensify going forward. Mm-hmm. That's going to be a problem for the Fed.
Yeah, it's interesting that you bring up, the example of fuel prices.
Mm-hmm.
The Canadian government helped take care of, fuel prices that were coming down by instituting a new carbon tax, and that's brought prices back up significantly around here as well. So it's like you can't win no matter what. And I wonder how that affects the majority of people that are really maybe living paycheck to paycheck and borrowing, at record levels here to just try and make ends meet.
They run out of time. I mean, there's a timeline on it. There's an expiration date almost. And, it's also, from the context of fuel, I mean, to me, it's like gasoline. Nothing's ever a one-way street. There's always risk. I mean, natural gas is a great example. Everyone thought it was going to explode. You're going to have shortages, and didn't happen. Diesel fuel last summer was supposed to be shortages, didn't happen. But having said that, with the politics around this global warming, which is not global warming, there's no such thing as global warming, okay? It is solar warming. This is much bigger than just planet Earth, all right? And thinking that we stop driving, drive electric cars, you can talk all about the batteries, how dirty it is to mine all this stuff for the batteries. Oh my God, it's kind of ridiculous when this is what we're doing to ourselves, frankly. But it's one of those things where it's almost like a one-way street. I mean, gasoline prices to me will be much higher in the future, and that's going to be a problem. So, again, if you're looking at every little thing, and let's talk about even like food, you can see, and all these inflation numbers, the retail sales numbers were dreadful on Friday, really bad. And when you look at the dollar difference in a monthly sales this month versus a year ago, it's dramatic. And when you then apply the fact that these are not price adjusted numbers, the volume of stuff people is buying is really, it's right there. It's happening. All the kind of things we're talking about right now are right in front of us. And it's not as clear as it maybe needs to be for the general public or the pop media to understand that the consumer is choking when you're talking about nominally electronic sales down 10%. Well, that means on top of inflation, it's 15. When you talk about every discretionary item, vehicles, clothing, furniture, garden supplies, building materials, and what was the one I was just talking about? Furniture. all down versus a year ago. Department store sales down. I mean, it's really only online shopping that hasn't been down at least a year over year, at least one of these last 2 months. Mm-hmm. So, you can see the inflation is even worse, when you start to look at the retail sales numbers and understand how deeply negative these are. And in terms of food, really how much less food people are able to buy. It's palpable to me, it's tangible, it's in the data, and it'll become more evident in the, kind of in the headline data, if you will, and just right in front of people. Talk to anybody. I talked to my daughter the other day. She's talking about, she's got a 3-year-old and going to the grocery store, and it costs her 40% more to get the same groceries. So what do you do?
Mm-hmm. So does the PMI data also point in that direction? And does that end up affecting, Main Street as well if there's less manufacturing?
Absolutely. But what's interesting about the PMI data, the ISM data, and really what I love to look at are the Fed regional bank surveys. All right. Richmond, Kansas City, Dallas, Philadelphia are the main ones, right? Mm-hmm. What's happening is the service sector is finally coming is loose going into the corner, to use a racing phrase, right? I mean, so it looks to me like it's about to hit the wall. And if you look at some of the numbers like new orders, the backlogs, and you read the comments, people are saying we've worked through our backlogs because new orders have not met what we thought they would be. We're hunkering down for a further slowdown in the future. They see the pipeline demand is already soft and weakening. And you could say some of these readings have been at recession levels. There are readings even in the service sector from several, ISM, PMI, or the regional Fed surveys that are at levels that have only been seen in the past in the post-tech bubble crash in 2008, 2009, and in the pandemic. I mean, and now. So that to me is like, certain numbers are strong. People don't want to look at the labor market. Okay, so we're still pumping out 250, 300,000 jobs, a month. The problem is the labor market is dysfunctional, number one. And number two, it's the most lagging indicator out there. Why are we using the most lagging indicator to decide when the Fed should change their narrative? And you go back to Volcker, and I know I'm kind of twisting this around, but it's an interesting point, mm-hmm. because there's new commercials about some History Channel thing that's going to be on Ronald Reagan. And when he came to power in 1982, was just when inflation had come down. Volcker was able to start to bring rates down a little bit. But what was happening? Well, they show these protests during his inauguration, people walking around with signs, I need a job. And it's like, is that what it's going to take for the Fed to kind of, say, hey, we've beaten inflation, let's start protecting the economy. Mm-hmm. So, again, a lot going on. I mean, there's just so much to contemplate right here, which is what makes it so much fun to do this every day.
Mm-hmm. Well, you bring up the point about Volcker and about when they were fighting inflation by obviously getting the Fed funds rate above the inflation rate. How much different is that situation now because of the amount of debt that we currently have?
Yeah, it's a big difference. But at the same time, again, in 2018, 311 pages or 11 papers, over 300 pages of white papers from the Fed on the new policy paradigm. Mm-hmm. And that included R-star. There were at least 3 papers on R-star. And not many people read these. I downloaded and read them all. And I noticed on one of them, there was only like 600 downloads. It's like, so not a lot of people read these papers. Mm-hmm. But they're fascinating. And the Fed has done everything they told us they were going to do, including going too far, starting too late. All the mistakes they made, they kind of telegraphed. In this context, R-star is the formula that tells you where is neutrality. And they figured out for the U.S. and for most of G7, neutrality is 25 to 50 basis points above the rate of inflation. Depending on what inflation rate you want to use, I prefer CPI. Of course, they use PCE. It's about a 50 basis points difference. CPI is usually higher. But in that context, so let's take CPI. Now it's at 5. It just dropped from 6. We think it's definitely going to have a 4 handle. The question is, does it have a 3 handle, by June? And if it does, then that means the Fed at 5% is a lot more than just neutral. They are restrictive and almost prohibitively so, given what you just said, given all the debt. I mean, and all the debt that keeps piling up, and even the government debt. You're going to spend more money. And even they're talking now about, again, getting gasoline cars off the road quicker, trying to speed this whole thing up. I mean, it's kind of insanity when you get to the political side. There's no austerity anywhere in the country in terms of politics and the budget deficit that we keep running up. So all of this would be another almost record public borrowing. Okay, last year was $2 trillion. It was a record. You're talking about public borrowing of $2 trillion every year when the Fed is not buying $1.44 trillion annually anymore. That's a big swing. So, you have all of this kind of working into this thought process. the QT as well. I mean, so they ran QT for almost 3 years after 2014. It took them to get down 22% of the purchases they had let go, right? This time around, it was something like a year, and it was 12%, less than 12%. So is QT done too? If not, then that's a problem going forward. More supply, less buying. And to the degree that, you talk about R-star, I mean, gosh, you could make a case that they're neutral now, and neutral would be the appropriate policy given inflation is falling and the economy is teetering. But they probably go too far. They have it in their head they want to get to 5.5. And I heard some guy on TV the other day, and I sometimes got to shut the TV off. Some of these people that come on, and it's like, and he goes, well, the Fed needs to stay the course, get the job done. And it's like, get to 5.5. And what's the golden 5.5 number? I don't get it. I really don't. And I think the Fed is going to make another mistake using transitory mistake. They waited around way too long. Then they only hiked 25 basis points. Come on, that was a joke. They lost all their credibility and are risking making the same mistake on the back end now.
Well, I think that really brings up the point of, instead of just having a target of 5.5, who knows where they came up with that target, but the idea that the lags with which these policies end up affecting the economy and the markets, that seems to be something that you would want to pay a lot more attention to rather than just a target number, right?
Especially since the market is paying attention to that. Just look at the forward Fed funds, all right? I mean, the Fed funds for end of next year is literally 342. What's interesting is the 2-year note is 422, and then this year's Fed funds is still not even 475. So, I mean, they're pretty dovish in the short end of the fixed income market. I think you already see the 30 and 10s, 30 and 5s is uninverted. All right, it's now in a positive slope too. So I think there's some thought process they're going to have to stop. Maybe they don't want to, but they're going to be forced to because of the consumer. They got to protect the economy at some point in time, and in so doing, again, acquiescing to a higher level of inflation, which would be bullish for thinking that the yield curve is actually going to steepen. Right. So that's one thing out of this. But I think also the dollar, right? The dollar peaked much earlier than, you could say fixed income hasn't even peaked yet in terms of implied forward yields, even though I think it has. But the dollar peaked well before. And a good measure to watch is dollar adjusted by gold. In other words, just the dollar index divided by gold. Mm-hmm. It's a good metric to measure to some degree. Nothing's perfect. But if I had one thing to measure monetary conditions that the market sees, I would use the gold adjusted dollar index. That came off hard, man, and then did a bounce when the Fed kind of, if you remember back in September, October, they had to get tough again because inflation wasn't yet coming down, and their credibility to them, the inflation vigilance is at stake, and they, it was a little tougher rhetoric out of Powell at the press conferences, and you saw the dollar go back up, you saw rates made a new high, and you saw the gold adjusted dollar bounced and then started to come off again. So the market in terms of the currency is kind of pointing to what the fixed income market and the forwards is pointing to, which is the Fed is done and their next move is probably an easing. So, I think that from that perspective, they have to be paying attention to that. It'll be interesting to see. I don't think they hike rates. I think 5% is fine. Why do they got to go again? What do they gain by going again? Not only that, the best thing that's come out of this is they have ammunition now to use conventional monetary policy to ease when the next recession comes, instead of having to just go out and buy bonds en masse, which they'll probably do anyway.
Well, and of course, there's the whole argument that needs to be at least acknowledged of how quickly that is going to have an effect on the market. What degree to which they're going to have to print to make that, let's say, make that save because of that diminishing use of debt. All of that.
There'll be a lot more money next time around, that's for sure. And it keeps exponentially more. And it gets back to 2006 in the book, because I didn't finish that thought because it's a good one. MMT, right? And I wrote, the natural progression of this is until we get to monetary Armageddon. And the movies with the nukes and the president and the guy, the chief of staff have to turn the keys simultaneously, right, to set off the nukes. This is the Fed chairman, the Treasury secretary in the bunker, turning the monetary keys to print enough money to buy back every Treasury bond ever sold. Monetary Armageddon. And that's the day gold is $5,000 an ounce and a loaf of bread costs $100. Mm-hmm. That's where we're headed. I mean, that's almost the surefire ultimate outcome. And those that thought that, MMT would mean no inflation, well, they're being proven wrong in a big way right now.
Yeah. How does all of the debt end up affecting the unfunded liabilities as well? Is this really, almost an accelerator tacked on top of the devaluation of the dollar?
Absolutely. I mean, that's a whole nother question. You probably saw the one piece that I did on, looking at some of the pensions and some of the unfunded liabilities there, and it's out of control. It's a bigger problem. It's as big, if not a bigger problem than the national debt. It's right on par with that. So, again, when you start to think about all the potential landmines that are ultimately going to be stepped on, you're not going through this minefield without stepping on these landmines at some point in time. It means one thing: printing more money. It's the debasement of the purchasing power of your currency. The biggest trend that's been going on since 1971 that is still going on. You go back to 1971 and you say, what was the cost of a car? Or what was the turkey Thanksgiving index? Or what was a suit cost? And you look at where it is now. You see it. The problem for a lot of people is it's not just the U.S. This is everywhere in the world right now. And countries that have 30% food inflation where their currency's down 25%, holy mackerel. Think about that too. So, being U.S. centric here is a little narrow-minded, frankly. So that's also something to consider. And in terms of that, a lot of these charts, we're talking about the banking charts, and we're talking about the debt. You saw the deck that I put together, for you ahead of this interview. I'd like to offer that to all your listeners, viewers, whoever wants it. We'll send that PDF. It's actually, I tweaked it. I added the retail sales data because I want it to always be the best and the most recent, and it's a deep dive, and it's 100 pages long. And those charts, which I put together myself, as you know, those are not charts you're going to find anywhere else. That's an impressive, bunch of charts that will give you this story in the visual. Because I could sit here and talk all day. Where's the evidence? The evidence is in a 100-page PDF that I'm willing to send you.
Yeah, well, and that's exactly why I brought that up, because, again, very dramatic chart. You see that the public debt has crossed over the value of pensions for the first time ever, right?
Yeah. And last year they actually paid down some pensions. You even see like a city like Chicago, which is one of the worst offenders, actually, put a little money towards their pensions, which they took right back, end of last year when something else happened. I forget what it was in Chicago specifically. But yeah, that's a huge problem. It's one of those things like, it's like everyone knows it. It's like the Bank of Japan and the JGB market. Like everyone knows it's a blow up at some point in time. It's like, you're not going to class, you got to flunk out of college, but you just keep going on until you get the call from the dean, Well, I mean, there's a lot of calls from a lot of deans waiting out there for the consumer, for the government, for a lot of different, entities out there that have, lived beyond their means and borrowed craziness. And it's all well and good. And it's provided a nice lifestyle. And I think that we've lived in the sweet spot of that, because I think some of what's coming next is going to be really difficult and really tough for a lot of people to weather through. Unfortunately,
Well, that's why, we do the show, and we appreciate experts like you coming on to at least try and help educate people on what is likely coming, right?
And I think, in that context, that's where kind of gold and silver come in. Okay, obviously, that's even I've been bullish on the on Ether and Bitcoin just from the lows. Okay, we bought Bitcoin at 4,400, and then again at 8,800, sold it at 52,000, and waited it out and got back in. I thought it might even go a little lower than it did, but it didn't. Because it's, again, when you talk about the banking system, when you talk about the debt, when you talk about protecting the purchasing power of your paper, income, and wealth in particular, it's going to get even harder going forward. They will be printing more money. Every dollar will be worth less in terms of what it can buy. And keeping up, buy and hold in stocks may go up. Argentinian Bravo makes a new high every year. Do you think there's a better standard of living because of that? No, because inflation is eating those gains up in 2 seconds. So buy and hold in stocks, to me, is not going to keep pace with what's coming next. You're going to have to be more flexible, more nimble, and way more diversified. And you're going to want to be in currencies. You're going to be in the agricultural commodities in particular, and bond markets. I mean, that's why I love the futures markets, because you can be long or short just about any asset out there. And I think that's going to be important in terms of keeping up with the amount of debasement that's yet to come. So,
you mentioned not being US centric a moment ago there. In one of your reports, you said that India has gotten their headline rate above CPI. Can they actually fight inflation in this way, despite, let's say, the cost of energy and food, many other goods being dictated by much of the rest of the world?
Yeah, it's a tough one. I mean, you talk about fighting inflation, and you fight inflation by causing deflation in the economy. So, it is a balancing act. And the Fed, to me, is really kind of going a little bit too far. Now, the Reserve Bank of India did not hike rates at the most recent meeting. They were expected to fully. So it was a real shocker. But then what happened? Well, we just got the CPI report. And you saw a big decline in CPI. So all of a sudden now, CPI, is below the level of their official policy rate. So you have a positive policy rate. You have the same thing in Spain, where Spain went from 6.1 CPI a month ago to 3.3. I mean, that's, Godot has left the building, okay? And now 3.3 is below the ECB's main refinancing rate of 3.5. So all of a sudden, Spanish bonds don't look so bad. Indian bonds don't look so bad. You want a bond market where you have a positive real yield of 1.5 and a nominal yield of 7%? India is your story. So we try and watch. I watch every country that's, even countries that you don't think matter, like a place like Angola, where the currency's gotten crushed and they're a major OPEC, member, and holy mackerel, what happens if you take away Angolan production, stuff like that. So to me, everything matters. And what I think we do really well is connect all the dots and then create a story around how it's going to affect the markets. Mm-hmm. So, in that case, I think, buy and hold in stocks is just not going to keep pace. Having gold and silver is a must, to some degree of your portfolio. And I think even taking risk capital and, trying to do other things, whether it's through the futures markets or using ETFs now, which you have a lot of flexibility of some of the ETFs, not as good as I'd like them to be, but they still provide value for investors that want to be involved in stuff like cocoa. And El Nino, out of nowhere, you have La Nina, now you have El Nino. And they said a month ago, NOAA put out a report saying it was a 61% chance it could start by April. Very rare to flip-flop from one to the other, and it's already started. They just confirmed it yesterday or Friday. So that could have a big impact on food, and that could be your next wave of inflation. If energy comes down, brings inflation down, Fed kind of starts to back off a little bit, then El Nino hits and food prices go crazy. What's the Fed going to do? I mean, that is deflationary in and of itself. If you're talking, you have to spend more of your money to buy food, that's disinflationary for discretionary spending and for all the other things related to growth, mm-hmm. that you need to keep the debt from crushing you. Yeah. So, man, I wouldn't want to be the Fed chairman. You couldn't pay me enough money to do that job. And it's going to get harder, and it's going to get harder for everybody. And that's not to say there's not spots of light. I mean, there's a lot of, I think there's positive things, and we can still kind of unify as a country at some point in time. I think that will happen, and that will be a positive. But the degree to which the economy and, your money, you really need to be taking action rather than just sitting back and saying, I'm invested in stocks that's worked for 30 years. That's not the answer anymore. It just isn't, not in my mind.
Well, you know what? I wanted to ask you a little bit more about how you see, let's say, inflation going forward in a broader context. You've said a couple times Godot has left the building, but that makes me wonder how you see this, let's say, cyclical nature of inflation going forward. Do we see something like the 80s where, you had an inflation rate that made higher highs 3 times in a very cyclical like manner? And it makes me wonder if the next time that the Fed and the, central banks around the world have to step back in with QE and lower rates, as you said, the Fed has ammunition now, if that, brings inflation roaring back again.
Yeah, well, I would say that there's going to be a twist to the story, because Godot is like hiding behind the curtain. He hasn't actually left the room. Everyone thinks he's left the room, but he really hasn't. He's hiding and waiting to pounce out and scare everyone. Mm-hmm. And while that's kind of a neat little analogy, I think there's a lot of truth to that, and I think that as opposed to necessarily being cyclical, because I think the economy will tend to be less growth rather than more growth. So it's not like the growth itself is going to push inflation. It's the money. It's become a monetary phenomenon, more money, chasing less goods. And especially when you talk about some of the food commodities, man, you could see some real issues going forward with food. And then you want to talk about, a whole nother scenario of lockdowns and rationing and all kinds of stuff that the government could, impose on you that, was kind of, people want to say COVID was a precursor to what's coming next. And there's a lot of scenarios where that could be borne out to be true. And I think food could be one of them going forward. So I think it's more of a acquiescing to high inflation from a monetary perspective, and it's not necessarily cyclically driven. It's driven by printing more money. It's just that simple.
How do you see let's say the energy picture contributing to inflation as well going forward? We see all these changes. in OPEC, in how and where energy is produced. So how do you see the shakeups here affecting the price of energy and thereby affecting inflation as well?
Yeah, that's a good question. It's a tough one to answer, but I think that energy is a buy the dip mentality until it's clearly not. And that day may not even come yet, or even as fast as some people think it should or want it to, or whatever it might be. I mean, at the end of the day, let's take a big step back and look at energy, and let's see the forest for the trees, and let's talk about the new axis of power, which I've been calling this. I've been doing speeches on this probably since 2018, around the time 2019 for sure, before the pandemic. And the cause of that for me was when they opened a crude oil futures contract in Shanghai, traded in renminbi, using the Dubai OPEC benchmark as the contract. Hello? I mean, are we not ready for them to say we're only going to pay for our imports with renminbi and we're only going to accept renminbi for our exports? I mean, already now this has gotten a little more traction in the last couple of weeks when you hear they're talking to Brazil and South Africa and Russia. To me, Biden's made a couple mistakes. One was dissing the House of Saud in his first month in office, and they basically rerouted cargoes to China that were coming to the U.S. Yes, we do still import oil. I know everyone thinks, well, we're oil independent. We could be, but we're not. All right, we still import oil. And then to the degree that Biden did not go to the Olympics in China, where Putin and Xi sat down for hours, and all of a sudden they're invading Ukraine for food supply to ship to China. China's complicit in this, in my mind. It's China, Russia, and OPEC. And the fact that China has gotten Saudi Arabia and Iran to talk, I mean, there's your evidence right there. Mm-hmm. I mean, so to me, it's the new axis of power. I mean, Xi, if you know Xi, his dad was a major guy in Mao's regime, right? And he was killed in an assassination attempt on Mao. They whisked Xi away and basically have indoctrinated him with a Maoist manifest destiny-like mentality. He's well educated in the U.S. He looks good. He speaks well. He's a formidable guy that, we need someone that's equally formidable, unless we're just going to say, hey, take over the South China Sea. They've already gotten into certain skirmishes in terms of, flyovers, and with Vietnam, with Malaysia. Certainly the Philippines almost declared war on China. They threatened to declare war on China. I don't know if it was last year or 2021, but because of the naval dynamics around fishing and so on and so forth. I mean, if you look at a map, it's pretty simple where they want. Taiwan is number one, but it doesn't stop there. In that context, they signed during the Olympics a 30 trillion renminbi oil deal with Russia. It included Kazakhstan for shipments of natural gas to China from Russia. Also building a new pipeline through the Siberian passage to bring crude oil to China, all financed by Chinese state banks in renminbi. Why do you think Russia holds no dollars anymore? I mean, to me, the writing's on the wall in terms of the dollar and the bigger picture around energy and all natural resources. And this war that is basically a financial war that we helped, basically escalate by seizing Russian central bank assets. So, we're involved. And guess what? In this war, we don't hold the nuclear weapons. China does. And you say, well, mutually assured destruction, MAD. It was always the reason that China wasn't going to dump treasury bonds, right? And that was true, right? It's not true anymore. I mean, that was true until their economy caught up to us. And now it's passing us. Yeah, there's still problems in China. They got to keep unemployment low, to keep unemployment low, to keep the population, in check, because they want to rule forever. But think about ruling forever versus a new president every 4 years. And Xi, it's a different tone now, right? Some guy will complain in the NBA about human rights in China. The NBA slams them, right? But now, whereas China used to say, well, we'll try and do better, they say, look, you got kids killing kids. Your system doesn't work out so well either. Don't tell us how to run our system. We'll do it our way. So it's a whole different change in tone. Everything's changed there. And I think that that's the biggest threat, if you will, because, the dollar gets dumped as the commodity of trade and of resource pricing. That's a big deal. And you're talking about a stock market that's going to be really ugly and an economic scenario that's not going to be pretty. And that could be the end game for them in the first place.
Mm-hmm. So, Greg, what is the argument? You said earlier that gold should be at $4,000 or $5,000. How do you come to that number?
Well, I didn't say it should be, and I didn't say it's going there. What I said is if they're going to be doing certain things with monetary policy, like, buying every bond ever printed, yeah, you'd be there. Right now, my near-term target is 2650. That's a mathematical formula based on, the historical, movements that we've seen and what wave I think of this is in a, big secular bull market, which I think we go much higher over time. You also have, a situation where there's a bill now in front of Congress to, have a gold-backed digital currency, and it's be fractally, backed in some small way and stuff like this, right? For the state of Texas, believe it or not. So I don't know that that's ever come to fruition, but it's interesting because I did a speech in Miami maybe 3 or 4 years ago, and one of the questions was, if they wanted to go to a gold standard, where would gold have to go? And that's a really good question. And figuring it out, I came up with a number depending on which money supply. Do you want to do global money supply? Do you want to do global debt? Do you want to do? There's so many variations. You want to do 100% of M2 or whatever. But bottom line is, if you wanted to have a credible system, gold would be priced at $65,000 an ounce. That's how much money's been printed, man. It's insane. So gold standard is never going to happen because that's ridiculous. But some kind of fractal, if you will, backed currency, which China's also talked about. They're talking with, again, with the Brazilians, with the Saudi Arabians, with the South Africans, with the Russians about, a new basket currency that would be backed partially by gold. So when I look at that, I see it as gold is an asset that hasn't appreciated as much as other assets either. When you kind of look at gold versus crude oil, it's like, okay, I want to own gold, that's for sure. So I think it's kind of lagged, and I think that you're looking at 2650, if not 3000, the next time they print money. The question is, do we have a retracement first? And when I see some of the currencies now that are potentially breaking out, places like India, where now you have a positive real interest rate on your policy rate, you have a positive real bond yield, and all of a sudden the stock market doesn't look so bad and the currency looks good, and all of a sudden, like gold in Czech koruna, gold in Polish zloty, which just broke out. Like the strongest currencies right now are the ones that have the most deflation room to get disinflation. Like the highest inflation country, Poland, Czech, they've had huge inflation, almost 20% on CPI, headline CPI. And now you're seeing the disinflation, and those are the strongest currencies. And all of a sudden, gold in Czech koruna, Polish zloty, and even Indian rupee on a short-term basis looks a little iffy. So you had mentioned one time when we spoke about real, rising real yields. Mm-hmm. Would that be a threat to gold? And that is showing up as a potential threat to gold. So we'll see what happens there. It's not a one-way street, and we're never just always bullish. We'll play either side of the fence depending on, where the data tells us to go. And right now it's still, much higher. I think the first phase of this, if gold were to kind of wobble in other currencies, would be very bullish for gold in dollars because the dollar will be coming off. And I think par 82 on the dollar index is a key level, because that was your first wave down, and you came up and you matched around, and it matches the gold adjusted value of the dollar. And you're basically at a 0 52-week rate of change too, which will change because of the base effect in the dollar. Dollar rallied a lot this time last year, which will push down the rate of change as the dollar goes lower, which could impact gold bullishly. So I see a bullish scenario, but then I see, you're going to have to be nimble too if you're, investor, as opposed to someone's just holding it for safety in terms of, taking profits and looking to reload at lower levels. But lower levels at that point could be 2,200 coming down from 2,650.
Mm-hmm. Really not lower than, let's say, 2,000 coming back down below that?
If that happens, you're not going to be at 2,650. It'll happen from lower levels to begin with. I mean, right now you're looking at 1,800 as your kind of pivot point. It's the most recent low. It's the 52-week exponential moving average. So there was demand there. You saw, open interest. Here's the other thing I would point out. Gold to me is not a loaded trade right now. Not everyone's on board gold. I mean, open interest in the futures market is really low, actually. Mm-hmm. And any shake in terms of the second you see the 2-year note start to move higher in yield, they dump gold. I mean, you get a $50 decline because week longs are so quick to exit. I think there's a lot of kind of anxiety, or if not almost fear, around holding gold just because of some of the false starts. They say, well, gold hasn't gone up during this crisis. Gold hasn't gone up during inflation. It's because the dollar was up 20% year over year. I think from that perspective, gold held in really well. And now it's its turn versus gold and other currencies that's already made record highs to have its run. From here, the risk is 1,800. You get below 1,800, it's pretty straightforward. Then it's going to fail. Mm-hmm. But I don't think that's going to happen because I don't see the froth in the gold market that you would normally see with this kind of peak. So we'll see what happens.
Yeah, it's like the market doesn't, necessarily believe it as we're getting to these levels. But you mentioned the rising real rates, and just to make it explicit for our listeners, do you expect and how long do you think that we're going to be able to actually get rising real rates or positive real rates?
Yeah. Well, I think that's where you're going to see. So it's interesting because I've been saying in right now the stock market actually could break out, and it could break out because it's more correlated to the dollar than any other thing. All right, the dollar adjusted stock market leads the stock market every time. So stock market has upside in the near term. And I've been saying it's one of those things where inflation comes down and people kind of rejoice and they think they already telegraphing in the Fed funds forward market, already telegraphing, several rate cuts by the end of next year, if not one this year, even some pricing, right? Some odds, very small, but it's there. And that is to me like, okay, you get this kind of celebratory rally in everything, in stocks, especially in gold, on the fact that the Fed can kind of end their fight against inflation. But then all of a sudden, real yields are rising. And the economy is is wobbling. And the next thing you know, the consumer is not doing what you thought the consumer would do. And the next thing you know, you're in trouble because real rates are rising. And it was like when inflation comes down, could be when the stock market gets whacked because real yields will be rising. And in that case, I kind of feel like you might have 2-3 months of positive celebration. The Fed has won the fight against inflation. You got to buy stocks and it runs up. I don't think it makes new highs in terms of the S&P, but it might. But then I think that's when, the chickens come home to roost, if you will. It's a stupid phrase, but where you really start to see the pain in the economy that's not going away just because inflation came down. And when that hits, the stock market gets whacked, then the Fed comes in hard, and that might be your last gasp with gold, or it might be 2008 when gold goes down and everything goes down before the Fed acts, if they don't act quickly enough. Because let's not forget, they want to get to restrictive and then stay there for a while. What the heck does that even mean? I mean, they don't define these things because they don't want to be held to anything, nor would I. But they're not going to stay there for very long, I don't think. And I think the pain that will come in the economy will derail the stock market, which will force their hand eventually to make that turn.
Kind of all of that going back to the point of the lags that we spoke about earlier, right?
Yeah, right on. Exactly. It fits perfectly with that kind of overlay of the calendar. Absolutely. 100%. Good point.
So, with, let's say, holding some gold, some silver, what are the other, let's say, best performing industry sectors that you're looking at in this environment, Greg?
Well, that's a good question. I mean, we do a lot of quant work on the sectors in the stock market too. Right now it's kind of thin pickings, really, believe it or not, given that the stock market, the index itself doesn't look so bad. The S&P is kind of poised for a breakout almost on a short-term basis. But I don't look at it that way as much as I look at it like, what are the markets that are going to provide this? Not necessarily the industry sectors, okay? I think stuff like cocoa, some of the agricultural commodities, you can be involved with those in ETFs. Certainly the mining shares look really good here. We did a recent report, and that'll be in the PDF we'll offer your listeners at the end here, is my top mining picks too, in both gold and silver. Mm-hmm. So, from that perspective, certainly anything linked to gasoline. Did an energy report a week ago, and it's still the gasoline stocks, the ExxonMobil, the Chevrons, the Valeros that are really outperforming everything. I think that will continue too. So while we do get, sector work too, a lot of our clients are, wealth managers that are in the equity market too. I really think that going forward, people are going to have to be more involved in different things, have exposures to currencies. The FXF is the Swiss franc ETF. You can own that. The UDN is the down dollar ETF. You can own that and watch the dollar go down. Certainly you have gold and silver ETFs. You have commodity ETFs. You have coffee right now. It looks bullish. Cocoa looks bullish. Sugar has been on a roll. Cane, C-A-N-E, not Kane, K-A-N-E, on my Rangers who played tonight in the playoffs first game. All right, lifelong Ranger fan. But cane, the sugar cane, is the ETF there. And I think operating less of a buy and hold or an index fund, people should think just a little bit more like a CTA. Mm-hmm. And that scares a lot of people, but it's basically because the math in commodities is very, very strict. Like you can get whacked if you don't understand the math because of the leverage you get by, putting down payment on owning a contract of gold. You should look at it that way. You buy a contract of gold, it's $200,000 worth of gold. That's how you should treat it. Not like I got 10 grand in my account so I can own a gold contract. Right. All right. So we also do tutorials on that and teaching on that kind of thing. But I think for the average investor, getting more knowledgeable and being more active in their own kind of portfolios is going to be paramount to keeping pace with all the dollar debasement, all the currency debasement everywhere in the world. That's already been done and it's still coming. I mean, it's not going to end.
Mm-hmm. Greg, you look at a lot of currencies as well. Do you see let's say the commodity producing nations benefiting the most in what most see as what's coming as a global downturn here?
Yeah, that's a really good question because it's a trick question, all right? Because, and I know you don't think it's a trick question, but it is, and it's a trick question because I asked myself the same thing for a while. Why is the Canadian dollar not breaking out? Why is the Aussie dollar such a piece of garbage right now? Stuff like that, right? What you see is it's almost like the emerging market countries more involved in food are the ones that are breaking out. The Brazilian real, the Mexican peso had a not too bad run. I think that's a currency too. But even the commodity currencies, the main ones, Canada is right on the verge. It's right there at a technical level where it would be a bottoming pattern. It's a neckline, the 2-year moving average, all kinds of technical jargon right there with the Canadian dollar. So yes, I think those are the beneficiaries. I think that's, but I also think it's the currencies that have had high inflation where the central banks are credible central banks, like the Czech National Bank is a credible central bank. Certainly, the Polish zloty, the inflation has been crazy there, and the zloty got wasted on all of that. And these currencies are even breaking out against the euro. So sometimes that's difficult to own, but a lot of people open, some of these discount brokers, they offer all kinds of currency trading and all kinds of different things you can do now. So yes, I think it's the kind of the higher inflation countries that have the most disinflation to gain, and the commodity producers would be the ones to look at. And I think the commodity producers have been laggards, but that's about to change.
Excellent, Greg. Well, I think we've sure covered the gamut here. Is there anything else that you think that we should touch on before we wrap up here?
No, I mean, the last point I would say would be kind of energy, because it looks to me like it wants to break out, and we're talking about, deja vu all over again was one of the pieces we did recently about how last year at this time gasoline took off. I mean, you just had an 8-week consecutive decline in U.S. gasoline inventories. It took out 20 million barrels out of the inventories. I mean, you're way behind last year. You got a huge deficit. You're at a deficit to the 5-year low in terms of the 5-year average, right? A range of gasoline stocks. So I think gasoline's a commodity that needs to be watched too. The UGA is the gasoline ETF that you can also play. So we haven't talked too much about energy outside of the kind of the more macro political side, but I think the energy market right now is kind of poised and bullishly positioned, particularly gasoline. I'm not saying this is like, a 90% confidence trade or position, but I'm saying that the risk reward here is that something happens there. See, one of the things about the commodity markets you've had some of these commodity markets that come down a lot, like lumber and everything. What hasn't changed is the risk reward dynamics in the supply demand balance are razor thin, man. Mm-hmm. You don't have margin for error in some of these commodities. And you have an El Nino coming. You got a drought this year in the US. That's going to be bad news because you're already coming off crops that were supposed to be bumper crops in South America that were big, but weren't as big as they were hoped to be. And that would be a problem for next year if this is an El Nino. You see that happen here in the US, where I don't think a lot of people even realize. Last year in the US, according to NOAA, of the 48 continuous states, right? It was the most land mass categorized as in extreme drought in US history, more than the Dust Bowl, okay, in terms of how much of this country was in severe drought last year. So from that perspective, California drought, a lot of food supply comes from there. These are the things that I think where the risk reward dynamics would pay you to potentially be invested in these things, because the margin for error is so thin, and error is seems to be all around some of these markets. So that would be kind of my last words.
Almost like a reverse of what we saw in the oil price at the beginning of the pandemic.
Yeah, which makes it sometimes tough to even use a continuous chart when you got to deal with a -40 print in crude oil. It kind of messes up all the math. You got to use Brent these days because it didn't do that. But yes, I mean, the reverse of that. And what's a good case in point? Nickel. I mean, what happened with nickel with the LME. I mean, some Chinese guy who's one of the major producers of nickel in the world has a short position that's worth like 50 years of his forward production, and he gets in trouble, and they shut down the market and rip people off. We had trades that we had booked that day when they went back after the fact. We had put in market orders to liquidate our position the day before. They got executed on the opening. We thought we had huge profits, and they came in and wiped it out, and nickel opened, like 40% lower 9 days later with the help of JP Morgan and JB Diamond, basically complicit in this theft of money from small investors. Yeah. The most egregious breach of trust and market integrity ever. So that kind of scares me in terms of where else might this happen? What other commodities could they deem are critical commodities that maybe, hey, if you don't want us to trade nickel, that's fine. We won't trade nickel. But you can't come in here and do something like that. So, there's always risk, and there's always something you got to think about. But in terms of, could you see more of these kinds of instances like crude oil at minus 40, like nickel where they shut the market down? Yeah, you sure could. Absolutely.
How about nickel that was supposed to be there that ended up being a bag of rocks?
Well, but who found that? JP Morgan. Now they have this huge long position. They managed to mark the market down 40% the first day, and now they find out their inventory isn't nickel. Come on, man. When does somebody start investigating this stuff, man? It's ridiculous. I mean, I personally am out six figures. My clients are out millions of dollars. That was booked 2 days before the end of the quarter. I mean, we had we had incentive money coming that got stolen from us, and it angers me to this day. Not because of the money, but because of how they did it, and the fear that that's not something that couldn't happen again. But again, that's why we get up every day and do what we do. Anyone that wants that PDF can email me at sales@weldononline.com, and I'll be happy to send out that 100-page, open your eyes, visual evidence of what I'm talking about here.
The
PDF.
The 100-page treasure trove.
Yes. My what do they call that? What it's like some psycho writes his missive before he turns himself in, or he gets it to the newspaper. What do they call that? It's like a treatise or something, but it's particularly true when someone's kind of, anyway, I'm a nut for this stuff. So that's all I can say. I love it.
Awesome, Greg. Well, I really appreciate your time and sharing all your knowledge with us today. Of course, any listeners that want that, give them the email again, Greg.
Yeah, it's just sales@Weldon Online, WELDON online, one word, sales@weldononline.com, and we'll be happy to ship it out to you.
Perfect. And of course, your website, weldononline.com, and on Twitter, Weldon Live.
Correct.
Greg, thanks so much for your time today. Really appreciate it.
My pleasure. Happy to contribute. You guys do a great job. So kudos to you as well.
Thank you very much.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.